Well, first and foremost, welcome to Principles of Accounting 2. I am your host, Dr. B, and it's an absolute pleasure to be your professor for this semester. This is an 8-week course. We are in the second half of the fall 2022 semester. And the first thing we want to talk about as we explore the concepts of managerial accounting, which is what Principles of Accounting 2 is all about, is we talk about the financial statements that you learned from Principles of Accounting 1, and we talk about how to analyze these financial statements from a managerial perspective. Principles of Accounting 1 focused on how to develop the financial statements, income statement, balance sheet, statement of cash flows, statement of retained earnings. We talked about how to develop them and how to read them. That's what Principles of Accounting 1 was all about. In Principles of Accounting 2, I'm going to teach you how to analyze the financial statements, how to make decisions as a manager based on the financial statements. That is the goal of Principles of Accounting 2. And that's what we're going to talk about today and for the next 8 weeks. So let's talk about how to analyze the financial statements. So I'm going to talk about a couple of different methods that we as managers use to analyze the financial statements. We as managers need to interpret the financial statements quickly and easily. And one way we do that is through the use of ratios. Oh my God, Dr. B, I thought we were done with ratios back in Principles 1. No, we use ratios, financial ratios, and other computations in Principles of Accounting 2 because managers need to interpret the information quickly and easily. And one way we do that is through ratios. And so I'll show you how all of this works. So there's a few methods that we use in analysis. And I'll show you these different methods. But first, why do we analyze financial information? Well, there's a couple of reasons. As a manager, we need to be able to evaluate the financial health and performance of the company. As a manager, you need to be able to evaluate the financial health and performance of the company. And we do that by using different methods of analysis to understand the direction and the overall financial health, using things like ratios and other methods. We first start by looking at the past and current performance of the company. I'll look at previous years and compare year-to-year information to understand the past performance of the company. I'll look at 2022's current performance of the income statement. I'll compare that to 2021's performance. I'll compare that to 2020's performance and 2019's performance to understand the trends in the income statement. I compare year to year to understand the trends, of the income statement. So looking at past and current performance is very important to managers to understand the trends, the changes in the income statement. We also look at the current financial position, meaning how are we performing year to date? So I'll look at 2022's income statement, balance sheet, statement of cash flows to understand our current financial position. How are we doing right now? And also as a manager, I look at things like future performance and risk. The way that we can look into the future as a manager by looking at the current financial statements and the past financial statements, we can plan for the future. We can budget for the future. We can forecast for the future. Okay? By using our current and past information, we can plan for the future. So as a manager, we can do forecasting and budgeting. To plan for the future, we can also look at risk that might affect the company based on current and past risk. Now, who needs to see this kind of information? We have internal users and external users of financial information. We learned this back in Principles of Accounting 1, as you may recall. Internal users are people within the company. Internal is within the company. People that work in the company. Managers, employees, officers, internal auditors, the board of directors. These are people in the company. Okay? In the company. So internal users use financial information to run the company. Okay? Internal users use financial information to run the company. Day-to-day operations, planning, etc. External users look at the financial information to make decisions. Okay? External users use financial information to make decisions. Shareholders, lenders, suppliers, banks, everyone outside of the company are external users. The government is an external user. Shareholders are external users. Other stakeholders, lenders, suppliers, banks, etc. These are all people outside of the company. That's why I call them external users. They look at information to make decisions. For example, a shareholder will look at the current financial performance to either decide to buy or sell shares of the company. A lender will look at the financial performance of the company to make a decision to provide a loan or not to the company. Suppliers use financial information of the company to make a decision to provide a line of credit or not to the company. So it's important that both internal users and external users analyze the financial performance of the company to make their various decisions. I had mentioned that there are a couple of different ways that we can analyze the financial performance and health of the company. There are 4 different methods of analysis that we use to understand the financial health and performance of the company. The first of that is called liquidity and efficiency. Who can tell me in the class today? Who can tell me? What do you think the word liquidity means? What is liquidity? What do you think it means to be liquid?
Is it to be able to break down like somewhat is the I know how to explain it in like business terms, but liquidity in general, I think it's just like you have an asset that I guess can be melted down to something smaller, something more tangible, I guess you could say so.
Yeah,
Maybe.
yeah, you nailed it, Nick. Yeah, that's 100% right. So if we look at break it down into cash, exactly. So if we look at the balance sheet under assets, what do we have on the balance sheet under assets? Who can tell me what are assets and what do we typically have on the balance sheet under assets? First of all, what are assets? Do you remember? Principles 1 wasn't that long ago. What are assets?
Something someone owns. I guess it's like equipment. It could be
Yep.
rent, housing and so on and so forth.
Yeah, exactly, Nick. So assets are what the company owns. What the company owns. Cash is an asset because the company has cash. Inventory, that's an asset because the company has inventory. Accounts receivable, that's an asset because we expect that the company will collect funds from their customers. Supplies, it depends on supplies. Supplies can either be seen as inventory, or supplies can either be or can be seen as an expense. It depends on how the supplies are used, Adriana, to answer your question. Supplies can be used in the company to help to generate revenue. If that's the case, then it is an asset. If supplies are used and just consumed, like office supplies are, then it's just an expense. Inventory, yes. Inventory supplies, yes, that would be an asset, definitely. So cash, inventory, accounts receivable, these are current assets. Then we also have long-term assets or fixed assets, and this is what Nick was talking about. We have property, plant, and equipment. These are what we call fixed or long-term assets. The word liquidity, as you mentioned, is breaking it down into cash. The balance sheet is listed out in the order of liquidity under assets. Cash is the most liquid. I can use cash for anything, right? Then accounts receivable. I can collect the cash from my customers through accounts receivable. Yeah. Then inventory. I can sell my inventory. I can liquidate my inventory and turn it into cash. So it's organized, the balance sheet is organized in an order of liquidity. Yeah, and very good discussion. So yeah, that's what liquidity is. Liquidity and efficiency simply means how quickly the company can convert into cash. Yeah, that's what liquidity means. Efficiency means how quickly can the company convert things into cash. That's liquidity and efficiency. The other one here is called solvency. What does it mean to be solvent? What do you think? Who can tell me? What does it mean to be solvent? Solvent. What do you think? What does it mean to be solvent? Any ideas? Julie. Julie, what does it mean to be solvent?
Um, I unfortunately don't know the answer to that.
That's okay. That's okay. Christian, tell me, what does it mean to be solvent?
I think according to this one, it says the solvent refer to financial health of an individual or business, usually regarding rather the party has more assets than debt. I mean, I wrote it down a note.
That's correct, Chris. Yes, you're absolutely right. Nick, would you like to add to this?
Yeah, I just actually looked on Google. It was just having assets and access of liabilities, able to pay one's debt.
You got it. Yeah, exactly. The word solvent simply means the company has the ability to go out of business. That's what solvency means, yeah. What I mean by that is the company can pay all of their liabilities. Liabilities. The company has enough assets to use to pay all of their liabilities. That's what it means to be solvent. Solvency is a measure that we look at as managers and other individuals to understand if the company has enough of their assets to pay their liabilities. Yep. That's what it means to be solvent. So solvency is a great measure to understand the company has the ability to pay all of their debt. Yeah, very well done. Oh, this next one's easy. Yeah, profitability. Profitability, very straightforward. It simply means that the company can generate a profit. There's a couple of measures of profitability, things like profit margin. Yeah. That's profitability. We'll talk more about this. And the last one is market prospects. The marketability of the company simply means we're talking about shares of stock, bonds, equity. Yeah, that's the market area. So under solvency, we mentioned liability. Who can tell me what is a liability? What is a liability? Remember from Principles 1, what is a liability? Who can tell me?
Are there things that will have like pretty much expenses? The things that are my bad, I'm drawing a blank. You pretty much owe money on them, I guess. They kind of something like that, right?
Yeah, that's exactly right. A liability is what the company owes to someone else. A liability is what the company owes to someone else. Examples of this would be accounts payable. Those are bills that we've received but have not yet paid. Other liabilities would be wages payable. Our employees worked, but we have not yet paid them. Taxes payable. We've collected the sales tax from our customers, but we have not yet paid the sales tax to the tax agency. And then, of course, we have things like short-term liabilities, which would include short-term notes or other short-term debt. And then we have long-term liabilities. Examples of that might be a mortgage, a car loan, or a long-term bank note. Yeah, those are long-term liabilities. Yeah, excellent. Very good. So when we look at analyzing the financial health of the company, of course, we're looking at the financial statements, the income statement, the balance sheet, the statement of stockholders' equity, also known as statement of retained earnings, statement of cash flows, and then any notes. Income statement has revenue and expenses on the income statement. Revenue comes from sales. Yep. Revenue comes from sales minus cost of goods sold equals gross profit. Here's a formula I want you to know, okay? Very important formula. For the income statement, this is a formula. Revenue, which is sales, okay? Sales minus cost of goods sold. That's the cost of the actual inventory that we sold. So sales minus cost of goods sold, that's the cost of the actual inventory that we sold, equals gross profit. Sales minus cost of goods sold equals gross profit. Minus operating expenses. Minus operating expenses. Those are all your expenses like rent expense, wages expense, other expense, utilities expenses, etc. So gross profit minus operating expenses equals net income. Okay? So the whole formula together, sales minus cost of goods sold equals gross profit minus expenses equals net income. That's the formula of the income statement. Yeah. And that's how it's laid out. As you recall, when we read income statements in Principles of Accounting 1, we saw at the very top we have sales, which is revenue. Then we have below that the expenses. Yeah. In between, we have cost of goods sold. And cost of goods sold is only for businesses that sell inventory. They sell inventory. So that's the income statement. The balance sheet as you recall, has the accounting equation is on the balance sheet. Assets equals liabilities plus equity. Assets equals liabilities plus equity is the accounting equation, and that is found on the balance sheet. On the left side of the balance sheet, we have all of our assets: cash, inventory, property, plant, and equipment, etc. On the right side of the balance sheet, we have our liabilities and our equity. Our liabilities on the top right, and on the bottom right, we have equity. Liabilities include accounts payable, wages payable, taxes payable, other current liabilities, and then long-term liabilities. And then our equity, we have our owner's equity. We have paid-in capital. We have our outstanding shares of stock, etc. Yeah, what the owners own. Christian, please, Chris.
Yes, I have a question. So doesn't balance sheet always have to be a separate between does a balance sheet and asset and liability and equity, is it always separate a particular way? Like for example, asset has to be on the left side and liability has to be on the right side?
Yes, that's correct. That is what we call the standard format. So the standard format will have your assets listed on the left side. On the right side, top right side, you'll have your liabilities, and the bottom right side, you have your equity accounts. And the reason, Chris, why it's designed this way is if you think about the accounting equation, which is assets equals liabilities plus equity, if you read that from left to right, that's the exact way it shows up on the balance sheet. So the answer to your question is yes. That is the standard format for a balance sheet.
Okay, makes sense. Thank you.
You're very welcome. Excellent question. The third financial statement we look at as managers is called the Statement of Stockholders' Equity, also called the Statement of Retained Earnings. Okay, it has a few names based off of the type of company. Yeah, whether it's a publicly traded company or a private company, or if it's a corporation or if it's sole proprietor, whatever. That's why it has two different names. It could either be called Statement of Stockholders' Equity if it's publicly traded or had stock involved, or it could just be called Statement of Retained Earnings if it's a small private company. So the Statement of Stockholders' Equity shows at the very top, you'll see one that's called net income. That comes from your income statement at the end of the year. So net income will be at the top. And then it'll be plus net income plus ending balance retained earnings. And that will give you your new retained earnings. And then minus any owner's withdrawals or changes in stock or any type of dividends paid out. And that will equal your ending balance retained earnings. And that's typically what we see on the Statement of Stockholders' Equity. And then the last financial statement is called the Statement of Cash Flows. The Statement of Cash Flows shows the use of cash in the business. The use of cash in the business. This includes operating activities, investing activities, and financing activities. Operating activities on the Statement of Cash Flows shows the use of cash for the day-to-day operations of the business. Cash coming in from our customers that we receive from sales, minus cash going out for our day-to-day expenses, or paying our bills, etc., equals the net cash flow for operating activities. That's the first part of the Statement of Cash Flows. Is always going to be operating activities at the top. The second area is going to be investing activities. Investing activities, it shows us the use of cash for the purchase or sale of property, plant, and equipment. Investing activities includes the use of cash for the purchase or sale of property, plant, and equipment. Cash coming in from the sale of property, plant, and equipment minus the cash going out for the purchase of property, plant, and equipment equals net cash flow for investing activities. And the last part of the statement of cash flows is called financing activities. And the financing activities shows us the use of cash for financing activities like loans, stocks, bonds, etc. Cash coming in from the company taking out loans or issuing stock or issuing bonds, minus the cash going out for the payment of dividends, the repayment of loans, etc., equals the net cash flow for financing activities. And that's the statement of cash flow. But we look at these four financial statements plus the notes, because the notes are come in handy to tell us what happened. Yeah. We look at the four financial statements to analyze the financial health of the business. And the way that we do that is through ratios and through other methods of analyzing, like horizontal and vertical analysis, which we'll talk about soon. So, in order for us to determine if the company is doing well or not, we need to compare our financial results. And so how do we do that, right? It's important that we find ways to benchmark our company's financial performance to others. And the way that we do that is by looking at things like other companies that might be related to ours. We call these intra-companies. For example, let's say Amazon. Good example, I guess. Amazon owns other companies. They own other companies. Amazon is the parent company, and they own what we call subsidiary companies. Like, these are smaller companies, right? They own Amazon Prime. They own Amazon Video. They own Amazon whatever. Like, there's a whole bunch of them. Yeah? Amazon owns a lot of these smaller companies. When we compare Amazon, the parent company, to all of their smaller companies that they own, we call this intra-company comparisons. Don't worry too much about that, but I just want you to understand what it is. Yeah. Our company, we can compare ourselves to our competitors. For example, I like Macy's. Macy's is a nice store. So Macy's, let's say we're Macy's. We would compare ourselves to J.C. Penney. We would compare ourselves to other big box retail companies that sell similar products to us. Those are our competitors. So we can compare our performance to other competitors. This is usually only true for publicly traded companies. The reason why I say that is because, let's say Alejandro has a printing business that he uses for making the business cards and making the flyers, etc. But it will be difficult for Alejandro to compare his business to the competitors because he might not have access to his competitors' financial performance. He might not be able to see the income statement, balance sheet, statement of cash flow, statement of retained earnings from his competitors because they're probably not publicly traded. So it's difficult for Alejandro to benchmark his company's performance by his competitors. But one way Alejandro might be able to benchmark his performance is by looking at the industry performance. Okay, so in other words, Alejandro can do some research and say, okay, so my company sales are this. The industry, the printing and advertising services industry, the financial performance is this. I'm here. I can. That's one way Alejandro can compare his personal small business to other businesses in his industry. So industry is another area of benchmark. And the last one here is guidelines. Guidelines are relatively vague, but some industries have certain guidelines that they have to follow, certain metrics that they have to meet. Like, for example, the airline industry has guidelines that they have to follow. Safety guidelines, on-time performance, miles flown, etc. There's certain guidelines that they have to follow. So they might use guidelines as one of their benchmarks. But these are the standards for analyzing information. There are three ways, three tools, three methods, three tools that we can use in order to analyze the financial information. We have horizontal analysis, vertical analysis, and ratio analysis. This is going to be important for your homework assignment for the discussion board. Okay? So please pay attention, especially to these first two parts. Horizontal analysis. This is where we compare our financial performance across time. Here's what I mean by this. I can use horizontal analysis to compare my company's performance from 2022 to 2021. I can compare 2021 to 2020. I can compare all 3 years through horizontal analysis. If I look at my income statement and it shows me my sales, revenue, and my expenses and my net income, I can compare my revenue of 2020 to 2021 and 2022 to 2021 to 2020. I can compare my revenue for those 3 years. That's what it means to compare the financial performance across time, from year to year. How did I do this year compared to how did I do last year, and how did I do the year before? That's comparing horizontally. Horizontal simply means across time. Yeah. From year, it's typically always year to year to year. 2022 compared to 2021 compared to 2020 financial performance. I can do that for the income statement and the balance sheet. For vertical analysis, I can look at my financial performance expressed as a percentage. Okay, here's what I mean by this. For vertical analysis, I can compare vertically, up and down, yes? For each financial statement. Here's how it works. On the income statement, I can express every line item on my income statement as a percentage of total revenue. I'm going to say that again. On the income statement, for vertical analysis, I can express every line item as a percentage of total revenue. What this means is I can identify all of my expenses expressed as a percentage of total revenue to determine the percent change in each of those line items over time. Okay? So if I look at 2022, for example, and let's say my revenue is $1 million. and I have expenses of 500,000. What that tells me is my total expenses 500,000, my revenue was 1 million. 500,000 divided by 1 million gives me a total expense of 50%. The 50% represents my total expenses compared to my total revenue. Now, that's what vertical analysis does for us. I'll go into further detail on that here in a little bit. The ratio analysis is the third method for analyzing the financial performance. We look at certain ratios like solvency ratios, liquidity ratios, profitability ratios, and a few other ones to quickly identify the financial performance of the company. And I can take those ratios and compare them, benchmark them to like the industry standards and competitors, etc. Those are the three primary tools that we use to analyze the financial performance of a company. Looking a little bit more in detail at each one. Horizontal analysis, again, is looking at the financial information across time. So I can compare 2022 to 2021 to 2020, etc. Now, when I compare the changes over time, I use a formula. I look at both the dollar change and the percent change. The dollar change shows me how much each line item on my income statement and my balance sheet has changed from one year to another. If I'm looking at 2022, I need to compare that to 2021. So 2021 will be my base period. My base amount is 2021. So I take my 2022 dollar amounts and I subtract them from my 2021 dollar amounts. For example, if I have $1 million in sales for 2022, and last year, 2021, I had $800,000 in sales, my dollar change is $200,000. 1 million minus 800,000 is $200,000. So my dollar change is 200,000. Makes sense so far? Yeah, you all good?
Yes.
Awesome. Thank you, Chris. In addition to looking at the change from a dollar amount change, I can also look at change expressed as a percentage. We call this percent change. This is a very useful formula because you can do this for a lot of things. Okay. Percent change, here's how it's calculated. We take the analysis period 2022 amount, dollar amount, minus the base period amount, 2021, divided by the base period amount, 2021. And then we multiply that by 100 to get the percentage. So here's my example. Okay. In 2022, I had $1 million in sales. Okay. Minus my sales from 2021, which was 800,000. That gets me 200,000 on the top part of the equation. So 200,000 divided by the base period amount, which was 2021 sales of 800,000. So I go $200,000 divided by $800,000 equals 0.25. If I multiply that by 100, That gets me 25%. So in other words, my sales increased by 25% from last year. Make sense? Very useful formula. Very useful formula. So please remember this one. It'll come in handy, I promise. Visually, let me show you visually what this looks like. I had mentioned that you can do the horizontal analysis for both the income statement and the balance sheet. This is what it looks like on the balance sheet. We can see the comparisons in both dollars and percentage. So let me take one piece to show you the example. Let's look at total assets. Total assets this year for Apple was $375,319 million. Yep. That's a lot of millions for those of you keeping track. So that's this year. Last year, Apple had $321,686 million. That's a lot of millions. So the first thing we do is we find the dollar change. Very easy. You just take the current year minus the prior year. The difference is 53,633. Now we can find percent change. How we find percent change? Current year minus the prior year divided by the prior year. Current year minus the prior year, that's 53,633. Divided by the prior year, 321,686. That gets us 0.167, multiply by 100, and that gets us 16.7%. And you can see that we do this for every line item on the balance sheet, and we do it also for every line item on the income statement. This is what it looks like on the income statement. This is a consolidated income statement, of course, but we can see how it works. Now that's pretty cool, right? I think it's cool. That's the horizontal analysis. That was horizontal analysis I just showed you, which of course is a part of your discussion homework assignment that's due on Sunday night that I'd like you to start today. Yeah. Another tool that helps us to identify the trends in the horizontal analysis is called the trend percentage. The trend percentage shows us the trends over time. It basically shows us how much things have changed over that time period. Yeah. So this one's pretty straightforward. We take the analysis period amount, the current year amount, divided by the base year. Now, if I'm looking at 3 years of information, we'll say 2022, 2021, and 2020, the analysis year is 2022. The base year is probably going to be 2020. So I take 2022's amount divided by 2020's amount times 100. That will give me my trend percentage. Shows me the pattern over those 3 years. And here's an example of the trend analysis in play. It's pretty cool. It's a nifty, just a quick way. And we can graph this as well. So like if you did this in Excel, you can easily graph that type of information. The graphs are really helpful to see the trends visually. Yep. That's why we use graphs. So that's horizontal analysis. Now we need to talk about vertical analysis. As I had mentioned earlier, vertical analysis goes up and down on each financial statement. On the income statement, we express everything as a percentage of total revenue. On the income statement, we express everything as a percentage of total revenue. On the balance sheet, which as you know shows assets, liabilities, and equity, we express everything as a percentage of total assets. Now here's how it works. We take the analysis amount and we divide that by the base amount. The base amount on the income statement is total revenue. The base amount on the income statement is total revenue. The base amount on the balance sheet is total assets. So we take the analysis amount divided by the base amount and we multiply that by 100. Here's how it works. On the balance sheet, we take every line item. Each line item individually is the analysis amount. So if I go cash amount, that's my analysis amount. So cash amount divided by total assets times 100 gives me the percentage for cash. So I'll show you what each of this looks like right here. So on the balance sheet, we see for cash, current year, $20,289. The prior year, $20,484. I express everything as a percentage, and I do this individually, for each year. So how did we get 5.4%? We took current year cash, $20,289, divided by total assets. Total assets for the current year were $375,319. So $20,289 divided by $375,319 gives me 0.054. 0.054 times 100 equals 5.4%. And I do that for every line item. And I also do that for every year. Okay. What this does is it provides me with a snapshot of the percentages for the current year and the prior year. And now as a manager, I can identify the trends. I could see the changes. Oh, my cash went down a little bit by 1%. As a manager, I might want to look into that. Why did that happen? What did I do with that 1% of cash? We see where it says total assets equals 100%. That's because total assets divided by total assets, 100%, obviously. We also see at the very bottom of the balance sheet, total liabilities and equity are also 100%. That's because of the accounting equation. Remember, the accounting equation is assets equals liabilities plus equity. Right? So liabilities plus equity together equal total assets. So therefore, also 100%. Just in case you're wondering why they're 100% in those two categories. And I do the same thing on the income statement. On the income statement, we express everything as a percentage of total revenue. Percentage of total revenue. Total revenue, as you know, is sales. That's why we see net sales, 100%. That is our total revenue. So cost of goods sold divided by net sales gives us 61.5% for the current year. I do the same thing for all of my line items on the income statement. Everything divided by net sales. And what this does, again, it shows me the trends from year to year, expressed as a percentage. We can show graphically also this type of information. It's helpful to see it graphically, just to give a visual perspective of our trends. We talked about horizontal analysis. We talked about vertical analysis. Now we need to talk about ratios. Ratios are very important for business owners and businesses to quickly be able to analyze the financial performance of your company in a very quick and efficient way. There are four kinds of ratios that we look at: liquidity, solvency, profitability, and market ratios. Liquidity, as we talked about earlier, is the ability to quickly convert into cash. That's what it means to be liquid, right? These are the 7 primary ratios that we use to quickly calculate the company's ability to convert into cash: current ratio, acid test, accounts receivable, turnover, total asset turnover, days in sales and inventory, days in sales uncollected, and inventory turnover. Yeah, there's 7. Yeah, it's a lot of ratios, I know. But each one has their own use. We also use, for liquidity, a ratio called working capital. Working capital is really important for all businesses. What this does is it tells me the amount of cash I have available to use in operations. Okay? The cash I have available to use in operations. I can use these operations by reinvesting into the business. That's what we call working capital. If I need to go purchase more inventory or purchase new machinery or whatever, I use working capital to do that. The formula for working capital is current assets minus current liabilities. As you may recall, current assets are assets that we use within 12 months or less. The word current in accounting means 12 months or less. That's what the word current means, 12 months or less. So current assets, those are assets I will use within 12 months or less. Current liabilities are the liabilities that I need to pay within 12 months or less. Current liabilities are the liabilities I need to pay within 12 months or less. That would include things like accounts payable, wages payable, taxes payable, and other short-term liabilities. So current assets minus current liabilities equals working capital. You find current assets and current liabilities, of course, on your balance sheet. The current ratio. This is the first one that we saw, yeah? Current ratio is current assets divided by current liabilities. This ratio is really important to tell us if the company has the ability to pay its current debt. Yeah. The acid test ratio. The acid test ratio shows us how quickly the company can convert things into cash. Yep. We take cash plus short-term investments plus accounts receivable. Short-term investments. Some companies will buy shares of stock in other companies and sell those within 12 months. And the reason why companies do that is, of course, to raise capital, yeah, to get some additional cash flow. That's what short-term investments are. It's just in case you wonder. So cash plus short-term investments plus current receivables, accounts receivable, divided by current liabilities. Accounts receivable turnover. Accounts receivable turnover shows me how quickly I can convert my accounts receivable into cash. We take net sales divided by average accounts receivable turnover. Average accounts receivable. Net sales, those are your annual sales or your monthly sales. Yeah, net sales. Take that from our income statement, net sales. That's your total revenue, yeah? Net sales. Divided by average accounts receivable turnover. When you see the word average, it means in accounting. When you see the word average, it means the beginning balance plus the ending balance divided by 2. Beginning balance plus ending balance divided by 2. When you see the word average in accounting, it means beginning balance plus ending balance divided by 2. So we take average accounts receivable turnover, average accounts receivable, beginning balance receivables plus ending balance receivables divided by 2. So net sales or net revenue divided by average accounts receivable gives us the account receivable turnover. How quickly I can convert my accounts receivable into cash. Another ratio is the inventory turnover. It shows me how quickly I can sell my inventory to turn it into cash. I take my cost of goods sold, which is found on the income statement, divided by average inventory. There's that word again, average. Beginning inventory plus ending inventory divided by 2. Again, shows me how quickly I can sell through my inventory to convert it to cash. Days sales uncollected. Okay, this shows me how frequently I can collect my accounts receivable from my customers. We take accounts receivable divided by net sales times 365 days. Accounts receivable found on the balance sheet, net sales found or net revenue found on your income statement times 365 days tells me how frequently I'm collecting cash from my customers on accounts receivable. Days sales and inventory. This shows me how quickly I can sell through the inventory to convert it to cash. I take ending inventory on the balance sheet divided by cost of goods sold on the income statement times 365 days. Total asset turnover. This tells me how well the company is doing in terms of using its assets to help the company to generate sales. This is a good one. We take net sales, net revenue, divided by average total assets. Beginning balance total assets plus ending balance total assets divided by 2. So that's liquidity. Now let's talk about solvency. Solvency, as we had mentioned, is a company's ability to go out of business by paying all of its liabilities, using its total assets to pay for all of the liabilities. That's solvency. There are 4 ratios to calculate solvency: the debt ratio, the equity ratio, the debt to equity ratio, and times interest earned. The debt ratio, we take the total liabilities divided by total liabilities plus equity. Total liabilities plus equity is on the bottom. So total liabilities divided by total liabilities plus equity equals the debt ratio. That ratio shows the total liabilities as a percentage of total assets. That's what it shows us. Debt to equity ratio. This one is important for the banks. The banks use this in order to determine whether to issue a loan. Yeah. The bank takes the total liabilities divided by total equity. This gives us the debt to equity ratio. Times interest earned. This shows the company's ability to pay interest or dividends. Yeah. We take income before interest and taxes, found on the income statement, divided by interest expense, also found on the income statement. Another set of ratios is profitability. Shows us the company's ability to generate a profit. There are 3 ratios for profitability: profit margin, return on total assets, and the return on common stockholders' equity. Profit margin, very easy. We take net income divided by net sales. This one is really, really important because it shows us every dollar of profit that we make based off of every sales dollar. So Alejandro, for your business, this ratio, very important, yes? Because it shows you the total profit you'll make on every dollar that you sell. Yeah. Very, very important ratio. Return on total assets. We take net income divided by average total assets. Net income is found on the income statement. Average total assets, we take beginning balance plus ending balance, total assets divided by 2. That shows us how well we're using the assets. Return on common stockholders' equity. Yes, this one's good because it shows us the company's ability to pay a dividend. We take net income minus preferred dividends divided by average common stockholders' equity. Again, the word average. Beginning balance plus ending balance divided by 2 for stockholders' equity. The last set of ratios is market ratios. We'll look at, there's 2 of them here. Price earnings and dividend yield. Price earnings, we take the market price per share of stock divided by earnings per share. Shows us the future growth expectations of the market for the company. And dividend yield, we take the annual cash dividends per share divided by the market price per share of stock. And this shows us the performance between companies. This slide right here, probably the most important one, because it shows you the summary of how to calculate all the different ratios, yeah, and what they all mean. Well, I like this one. Okay, we're almost done. And one of the last things we do as managers to analyze the financial performance of our companies is we summarize the data through executive summaries. We look at the overall analysis. We provide additional evidence. We make assumptions. We identify key factors, and we provide some inferences. So why is this all important, right? Why do we as managers analyze the financial health of our company? Well, it helps us to identify what we call sustainable income. Sustainable income simply means income that will continue to come into the business through operations. Yep. And there's a couple of things that add up to net income, like continuing operations through sales, discontinued segments, that's when we stop selling certain products, changes in accounting principles that might affect net income through write-offs, and earnings per share. All of these things affect net income. And we can see how that all breaks down on our income statement. Don't have to worry too much about it, it's just good to know. And that, my friends, is the end of analyzing our financial statements. Any comments, questions, or concerns on the information we just talked about? Y'all good? Did I bore you to death? Hopefully not. Any questions? No? You're okay? All right. I want to quickly recap the assignment. The discussion board is what you owe me. I want you to please start this today. Today. Please, please, please. The reason why I want you to do the discussion board today is because it'll provide you the opportunity to respond to 2 or more of your classmates, which is a part of the requirement for the discussion board. To access the discussion board, please come down to Module 1, Week 1. You'll find the Chapter 17 discussion board. We open this up. you'll see the prompt. Discuss the difference between vertical and horizontal analysis. We just did that in this lecture. So look at your lecture notes that you took, look at your PowerPoint slides, look at the book, and then try to find some outside resources by searching on the internet for these terms. You'll find some additional information that'll help you to craft a discussion between the differences of vertical and horizontal analysis. I'm looking for full paragraph responses. Please look at your classmates that have already done the discussion. Ms. Edwards and Rayan both did excellent jobs with filling out full paragraph responses. They also have the references included. Additionally, I'd like you to respond to 2 of your classmates with full paragraph responses. For example, Rayan responded to Ms. Edwards with a full paragraph response. That's the type of stuff I'm looking for in this discussion board that is due this Sunday night. Please do not be late, because late work is something that I do not accept in this course. Comments, questions, or concerns? Anything at all? Are you all good? You're all still with me? You're all still awake?
Yes.
Okay.
Yeah.
All right, good. Okay, so that's what we got going on. So please make sure that you start participating in the discussion board today. Today, please, please, please. If you think of anything, you need any help, any comments, questions, or concerns, you can always email me, call me, set up office hours. Whatever you need, I'm here for you all the time. I will be posting this video recording to my YouTube page and also to the discussions. To the announcements. Email me, call me, set up office hours, whatever you need, I'm here for you. I want you to please stay safe. Wash your hands. That virus is still going around. Wash your hands. Do the right things. I'll see you all again on Tuesday at 11 a.m. Thank you so much for your time today. Appreciate all of you. Have a wonderful rest of your day. Bye-bye.